Welcome to Budget 2026. Much has already been spoken about the budget that was presented a couple of days ago. What it means for the economy, its good, the bad, and the ugly, has already been spoken about, and it's still being debated in the parliament as we speak. While the idea of this video is not to delve into all of those, our reaction to the budget is pretty simple. It's fairly a good budget, which is intended to fast-track the growth in the economy while cutting the fiscal deficit further and while preserving the macroeconomic stability that we have achieved. So what are we trying to do here today? So we thought of helping you to make sense of what the budget means for your investments in the stock market and what some of the key proposals would mean for your investments. In essence, what we're trying to do here is today to help you to make some money and help you how you can position your investment portfolio to make the most out of it. So first, the budget has further cut the deficit to 5.1% of the gross domestic product in 2026, which is actually down from an estimated 5.2% in 2025. So what does it matter to us in the equities? Yes, it matters a lot. Lower deficit means lower borrowings, and lower borrowing means there will be less pressure on the domestic interest rates to move up. As you perhaps know, there is an inverse or an opposite relationship between the interest rates and the value of equities, and hence we believe the rates to largely remain at the current low levels in 2026, despite some uptick could be expected towards the latter half. But that is not going to do anything for the stocks in our opinion, and hence the rates are going to stay low and there will be a lot more runaway for the equities or the stock market. Second, the budget also proposes to spend an unprecedented 7 trillion rupees in the economy, out of which, as you perhaps know by now, 1.4 trillion is allocated for public investment, that is on building roads, the bridges, the power transmission lines, the irrigation, the housing, and so on and so forth. So this is going to send a positive benign shock through the economy, unleashing further growth in the economy. These monies will ultimately hit the business and household balance sheet, helping them to increase their top and bottom lines and thereby their valuations. And potentially we are going to an era where the valuations will have to be rewritten in the Colombo stocks. Third, while the budget is light on revenue proposals overall, which is fairly good in terms of maintaining the predictability and the continuity in the tax policy making, there is still one such proposal which is going to bring bulk of the incremental revenue for the government in 2026. In fact, some of the people actually was perturbed by this proposal also. That is to bring the value-added tax and the social security contribution levy minimum registration threshold to 36 million rupees per annum from current 60 million per annum, effective from next April. What it does is twofold, in fact. One, it could raise some prices in the short term as the tax net has now been widened a lot more, but it is unlikely to threaten the inflation target of 5% in the medium term in our opinion. Second, it is going to create a lot more level playing field as of now, because even the small firms will become liable for value-added tax and social security contribution levy, just like the big players, enabling them to be price competitive than before. So hence again, this is going to be positive from a capital market point of view. So next, while the vehicle imports have been made subject to the social security contribution levy of 2.5%, the biggest impact is coming from, not from that in fact, it is coming from the cut to the financing ratio, or which we call the loan to value ratio, by the central bank from the following day of the budget. This might dampen some demand for vehicles, which went through the roof this year with USD 2 billion worth of letters of credit has already been opened so far. Hence, this measure could help the banks to channel their money into more productive sectors of the economy as proposed in the budget, and thereby help the economy to ramp up further growth. At the same time, the myriad proposals to provide more lending to the SMEs, the small and medium enterprises, and the commitment for digitalization of state services and many other activities in the economy, as you have already heard from the budget speech by the Honorable President, could prop up the banking sector more, which has already gone up in value by a lot so far. So overall, we rank the budget to be highly positive towards the economy, the private sector, and thereby the capital market, with a strong potential for market to re-rate at a higher level. Key sectors such as construction, cable manufacturing, power and utilities, agriculture, banking are also at the forefront of benefiting from the budget, should all proposals are executed next year. So for more economic and market updates just like this, follow us at Capital Trust Securities.